All right, we continue to be nervous on this Tuesday. 30 minutes until the start of the cash trade. I'm Matt Miller. Dani Berger is off. Bloomberg Open Interest starts right now. Coming up, a surprise move. SoftBank sells its entire stake in Nvidia as Masayoshi Son tries to carve out his own foothold in AI. A weak outlook from CoreWeave as well, giving investors another reason to worry about the strength of the tech industry and these lofty AI valuations. And in the home stretch, the House gears up for a vote as the Senate passes a temporary funding bill to end the government shutdown. In terms of the stocks to watch this morning, obviously Nvidia is front and center. The stake that SoftBank held was, at least to me, surprisingly small, less than $6 billion, so like 0.1% of this entire company. But Masayoshi Son maybe needs the money. He's got to fund some other AI investments. CoreWeave cut its forecast due to delays from external factors like third-party data center developers, and you can see CoreWeave shares getting punished more seriously, down more than 8% in the pre-market. And Intel lost its chief technology and AI officer to OpenAI. Right now, those shares down about 0.9%. I think it says a lot for the company that OpenAI wanted to steal from their ranks. So let's talk about the nervousness, though. BlackRock's Helen Jewell summed up what investors are feeling right now about the AI equity rally.
The valuations don't look crazy, but they do if there's nervousness on the growth story. And that's why I think the AI story, of which we do remain bullish and we do think that there is a lot further to go, it is likely to be a volatile ride.
Joining us now is Bloomberg Tech co-host Caroline Hyde. And Caroline, a couple of reasons to make AI investors nervous. I mean, after all, if Masayoshi Son, who is a famed investor, really believed in the future of Nvidia and thought that the value was cheap, he would have held his stake, right?
But then you, as you rightly pointed out, $5.8 billion versus almost $5 trillion market cap. A man, the CFO of SoftBank, trying to point that, look, this money, this $5.8 billion, comes out of Nvidia, but then is reinvested in all of the people who are going to continue to buy Nvidia chips. Maybe that $5.8 billion is better spent elsewhere from Nvidia's perspective, because that then suddenly escalates in terms of future supply chain. It is right. It adds to the narrative of nervousness. It adds to the narrative that maybe Nvidia's run too far, too fast. But since they held and bought back a stake in Nvidia, remember, SoftBank sold back in 2019, regretted it, slowly clawed back, had about a $3 billion stake at one point, and then that has gone up to $5.8 billion because of this sheer scale of market capitalization accretion that we've seen happen to Nvidia. I think they were saying, it's the right time to sell, right time to deploy into maybe OpenAI and some other bets. And eventually that will probably serve Nvidia pretty well. But I'm right, it just adds to some of those nervousnesses.
Well, and CoreWeave doesn't help, yes, right? No. Cutting its forecast, regardless of the reason, is not something investors want to hear from a company like this.
And one that's still relatively new to the public markets, one that people are still trying to understand the business model of. And it's interesting, Mizuho's writing, Jordan Klein today, saying, look, this is why a lot of the people he speaks to are nervous about neoclouds, because CoreWeave's not the only one. You've got Nebius over in Europe. You've had plenty of others come into the space, but they're not really in charge of their entire destiny. They are deeply overexposed to supply chain headaches, to whether they can get access to the overall chips, whether they can get the data center builders to build the data centers on time, and this seems to be the issue there. It's good to see that they've managed to placate the overall purchaser of the data center, that they're still managing to hold on to that entire commitment of money being funneled their way, but it's not a good look. But these are some of the most read stories across the Bloomberg day in, day out, when data centers aren't riding out on track and all the supply chain headaches, power being one of them.
And we still have many multi-billion-dollar deals in tech. You mentioned Nebius, although it missed its third quarter revenue. It got a $3 billion deal, right, with Meta, and Microsoft is investing $10 billion on a data center, in Portugal?
Exactly.
Because it's so much nicer there.
It's lovely in Portugal, pretty tech-heavy, and they also can scurf. I know, all things to all health. But look, this is about the sovereign AI deployment as well, isn't it? This is about the fact that, yes, we can build in Texas. Yes, in the US, we can continue to build out data centers. But Europe wants its skin in the game. We're seeing Asia wanting to build out as well. We need neoclouds worldwide, it feels like, right now. But all of this still begs the question, are we seeing some sort of AI bubble? Some people are out there writing that this is silly media headlines, clickbait. Dare we do such a thing, Matt? But I think that at the moment there is just needing that vindication. Nvidia's numbers are going to be so important to this. The earnings and what little bit of fundamentals we can grab hold of. So it's not great when a CoreWeave misses, for example.
I mean, we don't need any clickbait, or certainly you don't on Bloomberg Tech, with these stories really driving the market every day. And we're talking about billions and billions and billions of dollars in deals. Carolyn Hyde will be anchoring that program with Ed Ludlow at 11 o'clock. Definitely tune in for that, because they have an interview with the CEO of CoreWeave. That is, again, at 11 a.m. New York time, an interview you don't want to miss. It is likely to move the market. Back to earnings. Paramount Skydance issued its first earnings report. It boosted plans for cost-cutting measures, including an additional 1,600 layoffs to help achieve $3 billion in savings. Bloomberg Intelligence media analyst Geetha Ranganathan joins us now. Geetha, tell us what you thought about the earnings, the layoffs, and in an industry where we could see even more job cuts if M&A continues.
Yeah, thanks so much, Matt. I think it was a really solid earnings report, given that this was the first one after the deal closed. Yes, there was some messy things in the quarter, but overall, I think the management team seems really solid. They obviously laid out a really good plan in terms of content investments, in terms of a lot of technological investments, how to drive AI for recommendation algorithms. The direct-to-consumer or the streaming product is one where they anticipate a lot of different cost savings. But you're absolutely right. I mean, just with the Paramount Skydance merger itself, a lot of it is banking on synergies. A lot of it is banking on job cuts. Obviously, we will see more of that if they do actually make a bid that is accepted by the Warner Brothers Discovery management team. A lot of that, still remains to be seen. But yes, job cuts are part of, the whole cost savings process, and they took up their synergy targets pretty dramatically. But the good thing is they are going to reinvest a lot of that into the content, into the tech platforms. So that's the bit of the good news there.
I mean, I wonder about the Warner Brothers Discovery takeover bid and how regulators are going to see that in an industry that has already, been decimated in terms of jobs. Would it be more difficult if they know that David Ellison wants to pursue the same model there?
I think it will be easier because it is David Ellison. We know that the Ellisons are obviously very close friends of the current administration. They just navigated this whole complex regulatory and antitrust landscape, closing the Skydance deal, even though that took much longer than initially anticipated. So I think, if anything, they are the best positioned to potentially close a deal with Warner Brothers Discovery. Yes, you're right in terms of the job cuts, but in terms of antitrust, concerns, I don't think that's a big worry for them at all.
All right, Geetha, thanks very much. Geetha Ranganathan there runs our media coverage at Bloomberg Intelligence. Let's turn, though, now to Washington, D.C. as the Senate passed a temporary funding measure to end the U.S. government shutdown. It will keep the government open through January 30th. For some funding vehicles, it'll go beyond until next September. The bill now heads to the House, where they will vote on it tomorrow. Bloomberg senior editor Mike Shepard joins us now. So, Mike, what do we know about what this funds and for how long, and how likely it is to get passed in the House?
Well, first, the question of whether it is going to pass. House Speaker Mike Johnson is assuring us of passage. He has said that he has locked up the Republican majority, and House conservatives, who can sometimes give their speaker a little bit of difficulty on sensitive votes, have indicated that they will support the measure as well. It has been embraced by President Donald Trump, who promises to sign it as soon as it hits his desk. The timing, though, is a little bit unclear, Matt, and that is mainly because the House has been out of session since late September. Lawmakers have to now make their way back to the Capitol, and of course the shutdown has made that so difficult with all of the disruption to air travel. So we'll have to watch how that impacts the timing of the vote tomorrow. And as you said, this will keep the government open until January 30th. Some agencies, and those include the Department of Agriculture, the Department of Veterans Affairs, the Food and Drug Administration, those will be funded all the way through the end of the fiscal year in September. But most of the other government's operations will only be funded until January 30th, and that tees us up for possibly another showdown over spending as soon as we hit the new year.
All right, Mike, thanks very much. Bloomberg's Michael Shepard there covering the end of the government shutdown for us. We'll keep you posted on anything that rolls across the ticker. Quick check on what's going on in terms of the pre-market headed into the bell right now. S&P futures down about 0.2%. NASDAQ futures off 0.5%. In terms of the individual movers on our radar, Microsoft, as I was just talking about with Caroline, will spend $10 billion on an AI data center along the Portuguese coast, one of its largest European investments this year. Rocket Lab earnings topped estimates and shares are higher despite a delay to the launch of its Neutron rocket to take on SpaceX in some regards. And the RealReal's turnaround efforts are taking shape. It boosted its outlook as the resale market continues to grow, as does its market cap. This company is now worth more than $1 billion. Coming up, CEOs are sounding remarkably upbeat about the economy. This earnings season, we'll take a look behind the optimism next, as well as the incredible growth of the U.S. dollar. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Blackstone's Kathleen McCarthy, who helped lead the firm's $320 billion real estate business, will leave the company after 15 years. She'll step down by year-end to pursue new opportunities. Her co-head will take over as sole leader of the business, which spans everything from apartments to data centers. In a statement, McCarthy called it an honor to lead the unit, and she's done it all at a remarkably young age. She's only 47 years old. Banks are ramping up use of synthetic securitizations, deals that help them offload loan risk and free up capital. Volumes have been climbing 18% last year to $673 billion. Santander surpassed Barclays as the biggest user, while JP Morgan and Standard Chartered also expanded. Regulators are warning of systemic risks as the market, now topping $1 trillion since 2016, continues growing at a quick pace. And Morgan Stanley is adopting KKR-backed technology to make it easier for wealthy clients to invest in alternative funds. The bank's wealth platform has added software that uses blockchain to automate and speed up fund transactions, a process that's been long bogged down by manual paperwork. KKR, Apollo, and Franklin Templeton are among firms offering products through the system, which aims to cut the clunkiness of semi-liquid fund investing. Executives are sounding more upbeat on the U.S. economy. Bloomberg data shows mentions of an economic slowdown during conference calls are at their lowest level since 2007. The confidence comes despite the disruption to official economic data due to the government shutdown, or maybe because of it. Joining me now is Michael Ball, Bloomberg macro strategist. So, Michael, this is fascinating because at the same time we have consumers who are facing, at the bottom end, slower wage growth and sticky inflation. Why are CEOs so confident on the economy?
I think they went in with really dire outlooks because obviously the tariff uncertainty was max going into the quarter in a lot of ways. We didn't have the China deal done. We're still seeing some peripheral deals getting done. And they weren't sure how much of that cost increase was going to actually be and also how much they would be able to pass on. So now they have a better sense of their ability to defend margins, and margins have been doing well. It's obviously different by sector to sector. We've seen that in tech having the best performance followed by healthcare. But it wasn't as bad as feared, and that's a big relief. And now looking forward, we're going to get the benefits of the one big beautiful bill. We're also going to see an easier financial conditions from the Fed easing, but also just generally from the better market conditions. And all that is helping them get a better outlook for next year. What
are those benefits expected to be from the one big beautiful bill? I've heard Scott Bessent lately extolling the tax cuts again, but for example, on the auto loan interest deduction, it has to be only up to $10,000 a year, only if you make less than $100,000 a year. And, the average new car costs $50,000, which people, I'm guessing, who make less than that aren't buying a new car, and it has to be a new car, and it has to be built in the U.S. Like, there's so many stipulations that it doesn't seem to matter in the end.
And on the consumer side, to your point, exactly, I've seen very varying numbers for how much money is expected to go back into the pocket of the U.S. consumer. I think one thing that's helping is the CapEx deductions are really giving a lot of confidence to where spending and costs will be on that side of the balance sheet and income statement. So overall, you're right. The consumer may not actually see as much benefit as the administration is trying to boost up, but generally the CapEx side will be better supported, and that will help.
But it does seem that the best way for corporate CEOs to navigate this tariff issue, the hit to margins, is to lay off employees. Are we going to start seeing the labor market start to loosen up?
Yeah, I mean, that's the worry, right? And that's what this week was sort of trying to get through. ADP today was interesting in some sense, but last week was all about Challenger and Warren bringing up cuts. These are obviously imperfect measures, and the earnings calls themselves leaned into that, saying that basically AI was replacing sort of lower skilled workers already in pockets of the economy. On top of that, when we look at NFIB today, when we look at Beige Book, this is all echoing that this no hire, no fire is sort of transitioning now into somewhat of a layoff concern. And that's why we've had the jitters in markets. Obviously, this valuation concern was on the forefront, but that alone is never enough. So I think it was this growth scare and the Fed itself pivoting to a more hawkish stance right as that was occurring that got sort of the risk sentiment to come off.
Let's talk for a moment about the dollar, because I know Joe in our control room has got a long-term chart. And, you know, when you talk about things being less bad than we may have expected, the doom and gloom that we heard on the U.S. dollar was so severe this year that this looks shockingly sanguine to me, right? We haven't really had the dollar devalue or dollar debasement relative to other currencies that we may have expected.
Right, and again, it's a couple things going on. One, it's other houses are not in order as well. We're seeing that in our major crosses, the UK, Europe, and Japan. Second, the Trump administration didn't come forth with all these capital account targeting things like sovereign wealth fund, the Mar-a-Lago Accord, all these things we thought was a purposeful devaluation by the administration, and why would you fight that? And that's what the buzz was in sort of the April time period when we not only had the tariffs to build credibility, but all these other things we're worried about in the backdrop. Remember, 899 section in the big budget bill came out, and that would have taxed holdings of treasuries. So it looks like the administration has stepped back from purposely devaluing the currency to basically promote our manufacturing base and our national security interests. So a lot of that has cooled, and that's a big part of this.
All right, that I think is absolutely fascinating and plays a big part in the markets. I mean, I'm looking at right now real U.S. underperformance, but especially for dollar investors. If you own the Euro Stoxx 50, you're up 31% year to date in dollar terms. If you own the IBEX in Madrid, you're up 57% in dollar terms.
I know, even like on the periphery, like Poland's one of the best performing stock markets. It's wild. And the carry trade's back. People are borrowing in yen or borrowing in Swiss francs and basically putting it elsewhere. They're coming back into the U.S. We have low volatility across the FX spectrum, and it's allowing for people to basically look and hunt for the best returns on a sharp basis.
All right, Michael, thanks very much. Bloomberg's Michael Ball writes for the MLive blog. You can get his work on your terminal by typing MLIV. Go. In terms of futures right now, we're still looking at red on the screen, about 0.2% down on S&P futures. NASDAQ futures down a little more because obviously these jitters, this nervousness continues around AI investment. Coming up, JoAnne Feeney warns that the bottom percentile of consumers have seen slower wage increases while inflation remains sticky. But can AI investment and the increased productivity from that make up for it? Stay with us for the answer. This is Bloomberg Open Interest. Concerns around AI firms investing in one another as the sign of a bubble may be overblown. Advisors Capital partner and portfolio manager JoAnne Feeney says these circular deals are another form of vertical integration. Through these deals, we have separate chip networking software and IT web-scale services companies behaving as a single entity. The separation is a better solution, allowing investors to choose to weight each source of risk differently by mixing and matching ownership stakes. And JoAnne joins us now. JoAnne, it's an interesting perspective, and we've got this chart that shows all of the circular deals, and you can easily imagine that it's just one company, investing budget in each of its units. But where does the revenue come from, if not for the hyperscalers putting money into the chip stocks, putting money into software? I mean, don't they need each other for revenue?
Yeah, that's exactly it, Matt. They do need each other for revenue. And that's why we're seeing companies like Nvidia invest in the companies that are building the infrastructure, which ultimately leads to the applications. And it's those end applications that we're all sort of on tenterhooks waiting to see. We're seeing some of it. Some of the industrial companies have been out saying how they're using AI. Some of the financial companies have been out saying how they've been gaining from the application of AI within their firms and for their customers. So I think that's why investors are nervous, though. It's really, when are we going to see more revenue from the applications? And I think that's going to be pretty hard to measure. But this, set of circular deals is sort of an indirect way of vertically integrating from the applications providers to the data center builders, to the chip providers. If they were all one company, we wouldn't be so worried about a company investing in its own development for new applications. So it's not a bubble in our view. It is simply a step in the progress of building this new capability that we are starting to see deployed into applications.
What if one of the links of this chain is weak? I mean, for example, what if consumers and institutions decide to use Gemini or Claude or any other AI chatbot than OpenAI, which seems to be assumed as the leader and winner already?
Yeah, I actually think that they're not assuming OpenAI is going to be the winner. I think what these companies are recognizing is that it's a race, and they're trying to enable their best prospects, like for Nvidia, to sell chips into whoever is going to be the winner. And so, funding the expansion of AI is a way to be diversified and so to be exposed to whomever becomes the winner. They already know that Google, Microsoft, Amazon are buying their chips and are in the race, and they just want to make sure they're exposed to all the potential winners.
All right, JoAnne, you're going to stick with us. We have a lot more to talk about ahead of this, or after, I should say, this market open. That happens next with the opening bell, one of which we'll see being rung from the Intrepid. As it is Veterans Day, we're seeing futures lower right now. This is Bloomberg. Moments away from the start of trading on this Tuesday, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at drops in futures, about 0.2% on S&P futures, a little bit more on NASDAQ futures, as SoftBank sells out its entire stake in Nvidia. I say entire, it's a very small stake. I mean, $5.8 billion to you and me is probably a lot of money. To Masayoshi Son, to SoftBank, it's a lot less money. And to Nvidia, it's far less, about 0.1% of that company. Nonetheless, it has rocked investors, or given them jitters, maybe is a better way to put it. Alto Neuroscience is a company that actually has tripled in value year to date. It's up 201%, but if you've owned it for 5 years, you're still underwater. It's off by a fifth. Down at the USS Intrepid, you've got senators there to ring the opening bell for the NASDAQ, as well as servicemen to honor veterans on this Veterans Day. Remember, the bond market is closed today, but the New York Stock Exchange is trading. In terms of stocks to watch, let's take a look at what's going on here. Nvidia is down 2.2% right now in the cash trade, so that shows a little bit of a lack of confidence, probably more than the selling of that stake is worth in the company, far more. CoreWeave is down 8.5%. So another knock to confidence is that CoreWeave cut its outlook, and this is one of the darlings of the AI build-out, one of the cloud service providers. And then Intel down 1.2%. Intel lost its chief technology officer and its chief AI officer to OpenAI. So across the board in big tech, you've got drops. Let's bring back in Advisors Capital Partner and Portfolio Manager JoAnne Feeney. JoAnne, would you say, I mean, if you're bullish on this sector, is this a buying opportunity for these companies?
Well, selectively, Matt. We do like Nvidia here, and we do think it's a core, should be a core holding for investors who have a sufficiently long time horizon, because it's likely to be volatile. You get news out of CoreWeave like that, quarter to quarter, they're likely to see some volatility. We know that it's awfully hard to maintain a steady pace of a build out and even to sell those application possibilities. So volatility is going to be the name of this game for a while. But we do see a pretty resilient build out on its way. It's been happening for a number of years now. We think it's going to happen for some years more. And, I think what we're seeing in SoftBank is a pivot towards being positioned to develop and sell those applications. So in some ways, that's a very positive move in the market because it's ultimately the applications that are going to prove the value of all this construction.
We see this rally in stocks all year, and maybe the last couple of years too, in part because of the huge CapEx spend here. The funding of this build-out is expected to drive growth in the U.S. economy. Is it enough to make up for the loss of consumer spending at the lower end? Because we've also seen income inequality exacerbated to a level some say we've never seen before.
Yeah, that certainly is an issue for the broader economy. And we're seeing that in the wage data, the data that we do have, showing that the lowest percentile of earners have seen a pretty sharp slowdown in their wage growth. It's still keeping ahead of the measures of inflation that we have, but clearly their spending power is being constrained. And we're seeing that in some of the lower end retail shops who are suffering from reduced spending at their places. But clearly the CapEx spend is elevating not just the technology sector, but also we're seeing it in utilities. We're seeing it in industrial service providers who are helping build those data centers. So it's having a pretty broad effect on the economy on that side of things, even as some of the lower end consumer households are really suffering here from past inflation and from potentially more limited job opportunities.
Does that continue? Inflation at 3% or more as the Fed cuts rates. Are you concerned that they boost inflation with these rate cuts?
Yeah, I mean, I think the concern, Matt, is that tariffs are going to boost inflation, and we've only seen some of the pass-through of tariffs to final prices, right? Firms have been absorbing a fair bit of it. They've been trying to rework their supply chains. Ultimately, does more of the tariff impact get passed through to consumers? And then, we'll see that in the broader price indices. It seems likely that that's going to happen. We have to see, obviously, how the SCOTUS decision comes out with regards to the legality of those tariffs. We may see a broad change in that structure. But clearly the consumers are under pressure, and that's why we tend to like some of the more sort of high-end consumer retail plays like a Williams-Sonoma. And back to the AI build out, we like some of the peripheral plays into AI, whether it's in the energy sector or industrials. There seems like there are an awful lot of opportunities out there. Companies that pay dividends, by the way, which can help investors ride out this volatility. Something we build into our balance strategy to create a more conservative approach to this market.
JoAnne, we saw the sell-off last week was driven by these tech jitters, this lack of confidence. But now the gains that we saw in yesterday's market were said to be because of the government shutdown coming to an end. So maybe investors did care about the government shutdown. If you had a crystal ball and could see that the Supreme Court decided against the legality of these tariffs using IEEPA, wouldn't you want to be short this market?
If they rule against the use of the tariffs,
the use of IEEPA to put tariffs in place, I mean, doesn't that cause at least short-term chaos?
Yeah, chaos is a good word, but think about the direction of that uncertainty, right? We have these high levels of tariffs now across countries. If SCOTUS rules against the legality of those for whatever reason, then presumably tariffs have only one direction in which to go, which is lower, which would be a positive for a lot of firms and small businesses. And we would expect to see their profit margins rise. Now, we know that there are a lot of deals already in place that are unlikely to be unwound. And we also know the administration has other tools for imposing tariffs, but those would take a long time. What it is sure to do is to create more uncertainty, Matt, which I think is kind of your question. And we've seen that uncertainty can delay things like factory expansion, hiring, and other things. So that would not be a good thing. But putting more money in the pockets of households would be a positive, and putting less pressure on profit margins for firms would also be a positive.
Yeah, it is an interesting thought experiment, but nothing more than that, because obviously neither of us knows, none of us knows what's going to happen. With regards to something that's maybe a little bit more predictable, and that is earnings, how confident are you that we continue at this pace of growth, or do we slow in 2026?
That is the question. What we've seen for the third quarter of companies reported so far is 13% year-over-year earnings growth, and that's up from the expected 7.9% before companies started reporting. So we've seen a lot better earnings than expected. We probably shouldn't expect that pace of earnings growth to keep up. And we've had a massive surge in spending this past year on those data centers. We should expect that to slow down, but put valuations in context. You look at Nvidia, people have been concerned it's too expensive. they're trading at like 34 times. The market's trading at 23 times earnings. But Nvidia's earnings are growing at 3 times the market. And it's only 150, it's only 50% more expensive. So that makes Nvidia look like a value. So I think people are a little bit over concerned about the valuations in this group of fast growing companies. The real risk, to your point, Matt, is what are earnings going to do in the future? We do expect a slowdown. It's only natural as the build out sort of continues, and it's going to go at a slower pace. But right now, we see valuations in this group as being pretty well justified.
All right, JoAnne, thanks very much for your time. Really appreciate it. Advisors Capital's JoAnne Feeney there on a broad-ranging conversation. Let's get a check on the market right now. We are looking at a drop in the cash trade, although it's pretty slight. You can see 0.2%. We're down not even 13 points here. This is the move screen, so you can see the breadth is more to the upside. 323 gainers and only 173 fallers. Of course, the big problem isn't on the gaining side of the ledger, but on the loser side, Nvidia, which is almost a $5 trillion company right now, losing 2.25%. That takes off all 12 points by itself because SoftBank sold its $5.8 billion stake. You can see Microsoft down today with a $10 billion investment in Portugal. Meta is down today with a $3 billion investment in CoreWeave, I believe. So Nebius, the other, what do they call it? A neurocloud, a new cloud, neocloud services, data center. Well, they offer solutions, obviously, for AI. Coming up, SoftBank sold all of its teensy-weensy little stake in Nvidia, worth only 0.1% of the world's largest chip maker. But it could be a sign that Masayoshi Son has lost the faith. Or perhaps he just needed the money. We'll talk about that with Ed Ludlow next. This is Bloomberg Open Interest. Quick check on stocks right now. We are looking at drops here. You can see very little change in the last 20 minutes of trading. The last 15 minutes of trading right now. The S&P still down 0.2%. The Nasdaq down a little bit less than 0.5% on concern that maybe some of these AI high flyers are overvalued. Time now for our top calls, some of the analyst action that's in focus this morning. And JP Morgan is up first with an upgrade to the satellite communications company Viasat to a buy, saying a separation of its defense and advanced tech units looks more and more likely, and so they're in for that. Viasat today up 4.5%. Next up is Instacart getting upgraded at BMO. The firm cites strong customer loyalty and rising order frequency. The analyst calls the company's outlook conservative and says shares trade at an appealing discount. You can see Instacart up 3.8%, 3.9% on that call. And finally, JP Morgan is cutting it trading on CoreWeave after the cloud computing firm said a data center delay will weigh on fourth quarter results. Barclays says the delay adds to poor optics in an already nervous market. So a number of analysts weighing in on this move. CoreWeave shares getting decimated today, down 10.5%. On top of CoreWeave, we're also keeping an eye on Nvidia after SoftBank unloaded its entire stake in the world's most valuable company. Bloomberg Tech co-host Ed Ludlow joins me now from San Francisco. And Ed, this is such a fascinating story. It could be read either way. Maybe Masayoshi Son thinks Nvidia is fully valued, or maybe he just needs the money. Either way, it's not a very big stake, certainly not 2.5% of Nvidia.
Right. The SoftBank narrative on it is that it's just purely financing, that they want to take the proceeds and use it to finance either their M&A strategy or the funding of the Vision Fund 2. Nvidia is down, 2.5% in the session, and that's having an impact on markets. But it did gain almost 6% in yesterday's session, which put it on track for its biggest jump since April. It's also not unprecedented. SoftBank has sold out of a full Nvidia position before. They did it in 2019. But then they changed strategy again in 2020 and built it up. And the paper gains that they've realized 2020 until about March of this year, significant anyway. So the way that the street's reading this is very much a SoftBank thing, not some kind of doubt about Nvidia or Nvidia's place in the AI build-out.
It's a great point. Even with today's drop, Nvidia is still worth more than its closing price on Friday because of the huge jump to almost $200 a share yesterday. Nonetheless, there continues to be concern about the sort of cyclical nature. We've been using that term, I guess, for the last 4 or 5 weeks at least, ever since that fantastic chart was created by Bloomberg News, of these companies' relationships with one another. And specifically with regards to OpenAI, they have to spend over $1 trillion, according to Sam Altman's plan, and they don't have anywhere near that kind of revenue. What are these companies saying with regards to how they're going to make the money to do this investment?
Yeah. I mean, to be fair to us, every time we've had an interview with Nvidia or AMD, for example, we've asked the question, are OpenAI good for it? Because that's who is putting forward the capital commitments. We've not really had that answer. Nvidia's position on the chart that you've just shown is that when it makes an investment in kind into OpenAI, an equity investment or chips in lieu of cash, they are not making any of that flow of capital to OpenAI a quid pro quo. OpenAI is not required to use NVIDIA chips. They could take capital from NVIDIA and use it on AMD chips if they wanted to. I think the bigger issue right now, if you want to kind of extend this to the CoreWeave story, is that all of the commits are there on paper. OpenAI says, we're going to do this. NVIDIA says, no problem, here are all the chips that you need. But the other parts are still missing. So in CoreWeave's case, a third-party data center builder has let them down. And they, therefore, are not going to book revenue that they had previously guided to. The energy side of it, I think, JoAnne, Feeney was just talking about utilities, right, in the previous segment with you. There is a lot of concern you can't print electricity, and that we don't actually, in the real world, see the electricity availability to match the on-paper commits to build data center infrastructure. That's what's happening in the market right now.
Yeah, it's got to be the biggest concern that investors don't talk about as much, right? The fact that there just isn't the energy there. And CoreWeave has had an incredible run-up. It's at least doubled since they went public earlier this year. So, and it's been one of the sort of darlings of the neo-cloud market. What does this? What do you expect to hear from the CEO? Because I know you're going to interview him in just about an hour's time.
So CoreWeave cut its revenue forecast for fiscal 25 to a range of $5.05 to $5.15 billion. It had previously been $5.35 billion at the high end. And what they were saying is that they're not able to meet a contract for a specific unnamed customer because a third-party data center builder let them down. Now, in the end, I'm just doing the math, that impact is less than $200 million, and the stock's down almost 11%. So the questions that a lot of the street have for CoreWeave are just like operational. Like, how can you control any of this? You keep telling us that you're supply constrained, that the demand from your customers is greater than your ability to provide the compute. But again, go back to the electricity portion or just the physical infrastructure portion. CoreWeave is a little bit at the whim of those that it partners with to build the capacity. And it's a very reasonable question to ask, like, how in the future are you going to prevent this happening again, where a third party lets you down? Because they keep telling us that in the future, that backlog or that demand for compute is going to double. So if it doubles in the future, are you doubly in trouble because you aren't able to get the concrete and the tin can data center up quick enough?
All right, Ed, great to get some time with you. Really looking forward to your interview. We'll all be tuned in at 11 o'clock. Bloomberg Tech co-host Ed Ludlow has an interview with the CEO of CoreWeave today at 11 a.m. New York time. And suffice to say, this is one of the two main companies in the spotlight when you talk about the market jitters that we're looking at today. Coming up, Warren Buffett says he's going quiet. We'll look at what that means from the Oracle of Omaha next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. Almost 25 minutes into the session right now. We are looking at losses, but they're pretty consistent in the first part of the trading day. S&P 500 down about 0.2%. NASDAQ down about 0.5%. The concern is the story that SoftBank has sold its entire stake in Nvidia. It turns out to be a very small stake, maybe even smaller than you would have imagined, only worth $5.8 billion, so 1/10 of 1% of Nvidia. Nonetheless, investors are asking questions about AI because of that and because of CoreWeave cutting its outlook. You can see Nvidia down about 3% and change. So a drop that's accelerating, and then CoreWeave down more than 10%. Right now, about 12%. A reminder: Ed Ludlow is going to speak with the CEO of CoreWeave at the top of Bloomberg Tech at 11. We see Rocket Lab gaining. This company has had to delay its little tiny rockets, but nonetheless, its earnings are good and investors have faith. It's up 5.7%. Core Scientific down about 10%. These are some of the bigger movers. The Real is getting a huge boost with strong earnings. It's worth $1.3 billion, or it was before this gain. Now it's worth 25% more. And then Berkshire Hathaway, it's unchanged, but I put this here because we had news yesterday about Warren Buffett. And we're joined now by Alex Rajbandari. He covers Buffett. He covers Berkshire for Bloomberg News. And Alex, Warren Buffett says he's going quiet with regards to the amount of writing he does for Berkshire Hathaway, with regards to the amount of speaking he does for Berkshire Hathaway, because he's obviously still very busy there. But what should we expect now from him going forward?
So he said he's no longer going to write the annual report, which was, a must-read for all Berkshire fans, full of witticisms and investment advice and pearls of wisdoms. He's also not going to speak at the annual meeting in Omaha in May. That is a big change because he was speaking for more than 4 hours and entertaining and taking questions from shareholders. However, he's
95 years old, we should point out.
Yeah.
So any kind of 4-hour speaking engagement for a 95-year-old must be difficult.
Yes, definitely. And it makes sense that he kind of gives that off to Abel going forward, who's going to be CEO next year.
Now, he is going to do a couple things, right? I think he's going to write still his Thanksgiving missive, and he's still going to the office every day.
He's going every day, 5 days a week in the office, looking at opportunities that come up. He speaks about that in his letter. And yeah, we're going to have more letters about that. These are the letters where he details all the donations to the 4 foundations of his late wife and children. That's going to happen in the years going forward.
He's done, what, $1.3 billion?
$1.3 billion. He wants to... This year. And he wants to step up the pace of donations to his children because they are in their 60s and 70s. So he wants to make sure that they have his whole estate before he passes away. However, he cautioned that he will keep a significant amount of Class A shares to make sure that shareholders are still comfortable with Abel as much as they were with Buffett and Munger.
Now, he still has an absolute ton of money, right? $150 billion, according to the Rich Go function on the Bloomberg. He wants to give away all of this by the time he dies or on his death.
That was his pledge, and then his children are going to take care of this and make donations. And he says that they are fully grown now into philanthropic people, and they can take care of this in a useful way for the society.
Alex, great to get you on the program. Great reporting on this. Alex Rajbandari covers Warren Buffett and Berkshire Hathaway for us at Bloomberg News. Coming up in the next hour, Crossmark's Victoria Fernandez says the bullish narrative for equities is alive, but is it? Well, then DWS Group, America's CEO, on taking advantage of a new American desire for European assets, and Tim Draper's AI clone joins us, or maybe he joins us. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Danny Berger is off today, and we're seeing another day of losses in equities on jitters about AI valuations. A surprise move driving this from SoftBank, selling its entire stake in Nvidia as Masayoshi Son tries to carve out his own foothold in AI, so maybe raising some financing there, or maybe he sees Nvidia as fully valued. A weak outlook from CoreWeave is adding to investor worries about the strength of the tech industry, the AI industry specifically, and the lofty valuations ascribed to it. You can see CoreWeave down 12%. And We're in the home stretch. The House gears up for a vote as the Senate passes a temporary funding bill to end the government shutdown. Now all of Congress has to fly back to Washington, hopefully make it there by tomorrow and vote to reopen the government. We begin, though, with stocks falling on renewed AI valuation concerns. JoAnne Feeney of Advisors Capital Management weighed in earlier.
And it's those end applications that we're all sort of on tenterhooks waiting to see. We're seeing some of it. Some of the industrial companies have been out saying how they're using AI. Some of the financial companies have been out saying how they've been gaining from the application of AI within their firms and for their customers. So I think that's why investors are nervous, though. It's really, when are we going to see more revenue from the applications? And I think that's going to be pretty hard to measure.
Joining us now is Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. And Victoria, I wonder what your take is on, these jitters are becoming more and more frequent. Concerns about valuations for a lot of the AI high flyers. How do you reconcile it?
Yeah, and rightly so, Matt. I mean, when we look at these numbers that are coming out and the CapEx that they're spending, yes, there's this positive component to CapEx going forward and the multiplier that it has on the economy and jobs. But we're also seeing free cash flow come down pretty significantly for these companies. And that's one of the reasons they've always had this nice high multiple placed on them, is because of the strength of those balance sheets. So it is affecting that. We're seeing more debt. Obviously, Alphabet, came and announced their new deal that they're doing, their debt deal. So we'll see debt ratios start to come down a little bit. And so I think there's a reason that people are concerned around valuations, and they want to see the monetization from this. And as was mentioned by your guest, I think that when you look at AI, it's not just these hyperscalers. How are we going to see AI come to fruition in the users? And that's where the key component is. And she's right, we don't have the answer to that yet, but that will be key in regards to valuations going forward. But they are a little high right now. Luckily, they have earnings to support them.
So I think the problem is the CapEx commitments, maybe not what we're seeing committed now by the big mega cap tech companies, right? Google, Microsoft, Amazon, they all have the money and we know it. But it was laid pretty bare when Brad Gerstner asked Sam Altman how OpenAI is going to invest $1.5 trillion when it only has $13 billion of revenue. And Altman snapped at him and said, I'll just sell your shares if you don't want to be part of this, right? How will they come up with that kind of money?
I think that's the million-dollar question, is how are they going to make these commitments come to fruition? And you've seen this circular component start to build, right? A chip company is going to put money into someone else, and they're going to use that money to buy the chips. And there's this circular component that has to give you a little bit of concern as to, if one of those links in that chain breaks down, what happens to all of it? And so I do think there's some concern there. We have to wait and see. Are they going to come to the market with debt? How are they going to get that cash? What does that free cash flow expectation look like? They are concerns that you have to look at when you're valuing these companies. It's why you're probably safer going with some of the big hyperscalers, some of those Mag 7 names that we know have the solid balance sheets to back that up, at least for now.
What do you buy right now? I mean, if you're confident of earnings, Victoria, and you think, this economy is a good support to a continued climb in the stock market. If you have fresh money to put to use, because you already own, I'm guessing, the Mag 7, what do you buy?
Yeah, I do think you have to be careful when you look at this, Matt, and it's what we've been talking to our clients about. Yes, there's these tailwinds to the market, the anticipation that the Fed is going to ease, the earnings component, the seasonality, stimulus coming from the one big beautiful bill next year, right? The CapEx. So you have these tailwinds, and you want to be invested in this market, and you can add to some of those positions on pullbacks in the market. But we also want to have a little bit of a defensive position. So you look at some of these sectors where they're starting to turn, they're starting to move into an uptrend. Look at healthcare. That's just now starting, and it's doing pretty well. Watch energy. It's not there yet, but it's getting there. I would add a little bit to utilities as well. And we like financials. We know when you look at financials as a whole, private capital and regional banks have had some concerns along with insurance, but those major banks, they continue to do well and they're responding to their trend lines. So those are places we think you can look to put money to work that gives you a little bit of a defensive posture, knowing that there's some yellow flags in this market ahead and you can help buffer your portfolio.
By the way, you have been cautious about the Fed giving us another cut in December, and we've had speaker after speaker over the last couple of days sounding a cautious tone on that. Is it going to be a real disappointment to this market if we don't get it?
I think the market needs to kind of temper their expectations for that December. I think that's what Powell was trying to do in the last meeting. He was trying to set the stage for the fact that maybe that won't happen. And we saw some repricing in the Treasury market. Yes, fiscal policy, inflation, that's pushing term premiums higher. But we did see a little bit of repricing due to the change in expectations there. And I think that's what the market should be looking at. You really don't need at this point in time probably another cut, especially if we don't get the government open and get all of that back data that we're looking for. Hopefully we do. But again, there's concerns around what those inflation numbers are going to be. And I think if the labor market just continues along the path that it's on right now, where it's not just falling off of the cliff, but it is slowly weakening, I think the Fed may wait until 2026 to do that extra cut.
By the way, I have a trader writing in, Victoria, asking if you like the base metal miners. Like copper or, Freeport-McMoRan, for example. And I think it's a great question because if you have a weaker labor market, you're going to have Fed support here that could lead to more inflation. And these are the things that we need for the AI build out, right? Like you can't put up a data center without a ton of copper.
That's right. And you've seen these names start to do better and better. And look, the Bloomberg Commodity Index just broke out as well. I mean, I think it's at a 2-year high. So there's some opportunity there as well. Obviously, when you look at some of the fine metals, the gold and the silver, those have pulled back a little bit, kind of reached those tops and pulled back. But I think you do have opportunity in some of those other mining in the materials sector as well.
Victoria, great to get some time with you. Really appreciate it. Victoria Fernandez there of Crossmark out of the Lone Star State. Coming up next, we get a look at the markets. Here we're seeing drops that are accelerating a little bit, about 0.3% on the S&P 500. The NASDAQ down about 2/3 of 1%. And this is on AI jitters. Now, yesterday we had at this time gains in the cash trade because of optimism on ending a shutdown. And President Trump has expressed his support for the bipartisan deal to end the U.S. shutdown. He spoke yesterday in the Oval Office.
I think based on everything I'm hearing, they haven't changed anything. And we have support from enough Democrats. And we're going to be opening up our country. It's too bad it was closed, but we'll be opening up our country very quickly.
For the latest, we're joined by Bloomberg Washington correspondent Tyler Kendall. So, Tyler, procedurally, what do the mechanics of this look like? Are we going to see the government reopened, by Thursday at the latest?
Yeah, hey, Matt. Well, that's looking likely. The House is set to come back and start its votes on this package tomorrow at 4 p.m. Eastern, which means that we could see passage by Wednesday evening. But that is only if everything goes as planned. House Speaker Mike Johnson can only afford to lose 2 Republican votes. And as you mentioned at the top of the program, travel delays could snag the schedule. However, it does appear like there are enough votes to get this done. We've seen positive indications from members of the House Freedom Caucus, those conservative Republicans that we've been watching closely, because there are some provisions included in this that they may not be happy with, including a reversal to the mass federal firings that we saw start on October 1st and a block on any future firings through at least January 30th. But there are 2 reasons that they appear to be on board. One, as you just played, President Trump says that he is behind this deal. And 2, this does not include any extension to those Affordable Care Act premium tax subsidies that's really been at the heart of the debate. Instead, this is teeing up a vote on the Senate side, not the House side, that's going to put Republicans on the record when it comes to health care, or we could see millions of Americans face a sharper spike in their premiums. So that's the next thing that we're going to be looking at, how the GOP navigates their health care plan. Matt, I will point out that this stopgap measure goes until January 30th. It does fund some key agencies through the rest of the fiscal year, but that means that we could be having this conversation all over again in the next couple of months.
So the Democrats forced this shutdown to try and get some of those subsidies back on Obamacare, and now they're giving in with nothing in hand. Is that a problem? Because Hakeem Jeffries yesterday sounded pretty angry, but it doesn't seem like he can do much about it.
Right. So essentially, Democrats weren't able to get what they really wanted out of this deal. We're going to see if there's some sort of similar vote offered in the House, because as of now, Democrats have their focus on a plan when it comes to health care ahead of a vote, probably by mid-December, on whether or not to extend these premium tax credits. And if it fails, then they're going to have their messaging for the 2026 midterms. Republicans are going to have to come out with a plan here, because many of these Senate Republicans are going to be put on the record. It likely won't look like a clean extension, a one-year extension of these subsidies that we know that many Democrats wanted. Instead, it will probably include some structural changes like an income cap or a new plan altogether. President Trump himself has indicated that he would be willing to negotiate on the issue, though he has taken harsh aim at these subsidies, which he has called handouts to insurance companies. Matt, I'll say I have my eyes on Senator Bill Cassidy. He's a Republican from Louisiana. He's going to lead these negotiations for Republicans in the Senate. He's proposed a new plan altogether that would essentially replace the enhanced subsidies with and send some sort of federally funded flexible spending account for ACA enrollees. So just something on your radar as we see these negotiations pick up. But that's not going to happen for at least another week. Now that the Senate got its jobs done, it's out of session until November 19th.
All right, Tyler, thanks very much for joining us. Bloomberg's Tyler Kendall there on the looming end of the government shutdown. Coming up, a setback for CoreWeave. We'll discuss the company's disappointing revenue forecast next. This is Bloomberg Open Interest. Let's get to high interest now. Look what's making headlines around the world. U.S. companies cut an average of 11,000 jobs a week in late October, according to ADP. That marks a slowdown in hiring momentum after months of uneven jobs growth. The data comes as the longest government shutdown in U.S. history delays the release of key economic statistics, including the granddaddy of all economic statistics, the non-farm payrolls report for September and October. Morgan Stanley is diving deeper into private markets. The bank launched a new research product focused on privately held firms as investor demand surges. The platform will feature reports and analysis on how private companies are reshaping industries. Two veteran analysts have shifted from covering public names like Tesla to tracking private players in AI and clean energy. Morgan Stanley joins JP Morgan and Citi in broadening private company coverage. And Point72's AI-focused Turion fund has gained about 30% this year, riding the wave of investor enthusiasm for artificial intelligence. The $3 billion fund that was launched last year looks for winners and losers across the AI hardware and semiconductor space. The surge underscores how central AI has become to hedge fund strategies this year. This story could be on NINSS. Sticking with tech, CoreWeave taking a hit after cutting its annual revenue forecast, citing a delay fulfilling a customer contract. Joining us with more is Mandeep Singh, Bloomberg Intelligence Global Head of Tech Research. And I feel like lately, on a daily basis, I'm coming to you like Chicken Little. Like the sky is falling, the sky is falling. I need you to reassure me that it's not. Is everything still cool?
It is, and look, when it comes to CoreWeave, they said the capex will shift from 4Q to 1Q because their suppliers are constrained in terms of giving them data center facility. And look, I mean, when I look at the backlog growing 85% quarter over quarter, so now they have $55 billion in committed contracts. That just tells you, even with a 5-year duration, they will be north of 11 billion in revenues next year, so more than double of 2025, and that's a very healthy sign when you look at their business, which is renting GPUs. The fact that all their GPUs, whether it's the older generation A100s, the Hopper, or the latest one, are fully rented. That's to me, that's a sign of good unit economics and really the supply demands still being in CoreWeave's favor.
But are we going to see more of this? There was recently a Sam Altman interview in which Brad Gerstner, who is an investor in OpenAI, questioned Altman's forecast of $1.4 trillion in spend, saying, look, you've only got $13 billion in revenue. Where are you going to get the money? And Altman got so angry, not only did he not answer, but he threatened to sell Gerstner's shares. Are there a lot of these guys that just have no plan for the funding?
Well, so OpenAI is unique in the sense they're not like the other hyperscalers where they have, $100 billion in free cash flow and then they are funding, with their own cash flow, the build out. OpenAI is raising money in the private market and from, other investors. So from that perspective,
they're raising money to buy chips from Nvidia, right? I mean, they're getting the money to buy this stuff from the suppliers that are going to sell them this stuff.
Well, a lot of the OpenAI compute will be on Oracle Cloud. So even though they're getting the chips from Nvidia, it will be hosted on Oracle Cloud, and then OpenAI gets to decide whether they use it for training or inferencing. Inferencing is more proportional to revenue generation. Training is sort of a sunk cost, but then you, generate revenue from the trained model over time. So look, I mean, right now there is a competition going on because everyone is willing to spend. It's just power is such a big constraint that OpenAI is talking big with the hope that they get a larger portion of the available data centers capacity and the power that is out there, because you can't grow power at the same pace the GPU units are growing.
By the way, I know that you're hosting an AI conference at Bloomberg Intelligence on private companies, because one of the most interesting private company CEOs that you've introduced me to, Samba Nova, is coming on my show tomorrow.
Yeah.
So what's your conference all about?
I mean, we're just trying to bring all these private companies and have them talk about not just AI, but all the emerging themes that they are excited about, whether it's quantum or, humanoids. And I think right now we are in an environment where technology is really such a big focus, as well as compute. I think never before we have had such a situation where, the build out happened at such a, rapid pace. And so having all these people come in and talk about, how they see things progress from their perspective would be quite interesting.
I keep thinking of the field of dreams, because if you build it, they will come, is a phrase that so many in Silicon Valley must be uttering. Will they come?
Well, we have a lot of application guys as well at the event. So from that perspective, when you've got real use case and you're solving a customer problem, I think being out there to use some of this compute, I think investors will be able to discern which are real use cases versus which are just, technology looking for a problem or something like that. And, the real use cases, I think, for AI have already emerged, and more so with the compute availability, you'll see more and more usage of that.
All right, what time does your conference start tomorrow?
It starts early, 8 o'clock, and it's a breakfast event, so 8 to 11:30. And if you're in the tri-state area, you should come over to the Bloomberg office.
All right, and if you're just watching us on television, we'll be breaking the news from your conference here. Mandeep, thanks so much for joining us. Mandeep Singh runs the tech coverage for us at Bloomberg Intelligence. He's got a private an event that's not private. It's open to the public, I guess, if you buy a ticket or whatever. And but it's about private companies in AI. CoreWeave's CEO, by the way, joins Bloomberg Tech today at 11 a.m. New York time. That's a public company and has been a darling of the stock market, but being punished today for delaying its forecast. Still ahead, Hepsen Uzcan from DWS Group. She's the Americas CEO. She joins us to talk about what American investors want. And surprisingly, well, maybe surprisingly, it's exposure to European assets, because the European equity markets have massively outpaced U.S. asset prices this year. If you invested in dollar terms in Madrid, in the IBEX, you would be looking at a 58% gain today. We'll tell you more about that next. This is Bloomberg Open Interest. Get a check right now on the stock market using the move screen for the S&P 500. You can see we're down just about 0.25% right now, but the breadth is to the upside. We have 317 gainers, only 183 losers. In terms of the stocks that are keeping us from bigger losses, Apple is up, Lilly is up, Exxon, so really a spread across industry groups there. The big problem, of course, is Nvidia, as it became clear that Masayoshi Son and SoftBank sold all of their stake in Nvidia. The stock is getting punished to the tune of 3%, which is a lot because SoftBank's stake was only 1/10 of 1%. In terms of the movers, in terms of the industry groups moving today, we had both Victoria Fernandez and JoAnne Feeney saying they liked energy, and that's the biggest winner, up 1.33%, because you need that power to run all of these AI data centers. Coming up, DWS Group making an aggressive push into the U.S., partially through tokenization. We'll talk to the CEO of the Americas. DWS, the asset management arm of Deutsche Bank, sees growth opportunity in the substantial outperformance of European equities. Dollar investors have gotten twice as much in returns from the Euro Stoxx 50 as the S&P 500. And if you bought the IBEX in Madrid for dollars this year, you're up more than 58% so far. Here to talk about her growth plans is Hepsen Uzcan, the CEO of DWS Americas. And Hepsen, great to have you here with us on set. I spent many years in Europe waiting for the outperformance. And a lot of times at the beginning of the year, there would be a head fake and we would think it was going to happen, you know, like value over growth. It never appeared. But now it's for real, and U.S. investors want access to those assets.
Absolutely. I mean, who would have thought that we were going to be talking about Europe? It's been so silent and muted for many years, but now Europe is back. And as a #1 asset manager in Germany, we are the gateway to Europe. It's really good to see, Matt.
So talk to us about the products you're offering to get U.S. investors, and which kind of investors are you courting? Retail? Is this institutional? I know you have 800 employees here, so what are you selling them?
I mean, we're so diversified, right? We operate in active X-trackers and alternatives business, and that's the case for both U.S. and our European franchise. But what I'm hearing, especially from the institutional clients, is how can we diversify? And diversification means how can I diversify geographically? How can I participate in Europe's growth? As you know, especially with the fiscal support that European governments are actually supporting on infrastructure, private credit, we really provide opportunities for our investors, and they're interested.
So here we have a lot of concentration risk. Obviously, the Mag 7 takes up a massive portion of the S&P or the NASDAQ. Are they selling some of their winners to put into global tech? Are they looking at other industries globally? Are there different factors globally that are winning here as momentum, winning there as momentum continues to dominate here?
I would say it depends on who you're talking to, right? Depends on your risk appetite and how you want to reset your portfolio. And when we talk about allocation, I don't mean huge allocations, right? Moderate but meaningful. One of the areas that we've heard strong actually interest is about our private credit and our infrastructure products. And that's an area that we are growing. The other area that we are very much getting interest is from Middle East. We just opened our Abu Dhabi office, and I think that investors globally are reconsidering Europe instead of solely U.S.
But there's no one specific wrapper, because you mentioned X-trackers, and I know I used to anchor the ETF IQ show, so I know that you have massively grown in that business, tripled your assets over the past few years.
X-trackers has been a great success for us in the Europe, and we have provided various actually products that reach to that magical numbers of $5, $6, $7 billion. And that's really a good growth area for us. We just actually launched our products in Stockholm, and we expect to grow across the European franchise. Some of the products that really focused on big data, AI, has really traded well for our company.
So this is a product in which you're already doing very well.
Yeah.
You have a well-known name. You mentioned private credit. Is that one of the shooting stars, you think, for DWS Americas?
I believe that's going to be. One of the things that I'm really proud of is our partnership with Deutsche Bank. As you know, when you think about the private credit market here in the U.S., it's a little bit saturated, and origination is the name of the game where a lot of actually players struggle with. With our partnership with Deutsche Bank, that certainly gives us an advantage as an asset manager.
You mentioned infrastructure as well, and I wonder how much of that is a play on the data center build out. We had a story today, Microsoft is putting another $10 billion in, European data center build in Portugal. Is that the kind of thing that you're investing in infrastructure for?
Infrastructure across Europe, the regular infrastructure, but aside from that, yes, data centers is another
including
play.
Roads and bridges.
Exactly. So really partaking in rebuilding Europe.
What about defense? That's been a huge part of the European investment story, right? We've seen a lot of money allocated to that, especially of Germany. Is that something that Americans want to be investing in?
It remains to be seen. We are working on a variety of products that are actually considering, especially in our Xtrackers business, but that could certainly be an interesting play.
And you mentioned investment in the Middle East. Are you doing that through partnerships? Do Americans want to increasingly do business? Every time I see a private equity carve out lately, there's a Middle Eastern firm attached to, KKR or Carlyle or whoever's doing it.
We actually opened our own office because we have a very strong alternatives business, so we did not see that we needed actually any partnerships. What we have done over the last few years is actually invest in our capabilities. As you know, in the United States, we have a really strong alternatives franchise on real estate, liquid real assets, and infrastructure. We did expand our capability in terms of real estate debt. And then this private credit partnership with Deutsche Bank is going to really increase and expand our product suite.
Well, and the good news for you, I guess, is that more and more people are talking about alternatives as well as ETFs in 401ks, right? So what kind of growth opportunity does that present?
Look, I think this is a subject that we've been talking about for many years, but it's finally here. I think retailization of alternatives, as I say, is live and well. So I think all of the firms really need to focus on how can I partake in this opportunity, and not just solely in the U.S., across the globe. When you're thinking about the pension reforms that's going to be taking place in Germany and many other European countries, we think that it's going to be a really unique opportunity for us, especially.
I have to ask about, the culture that you're fostering at DWS Americas, your leadership philosophy, and also about AI, because you can't not ask a CEO about AI strategy, right? So what's your vision for DWS Americas?
Look, I mean, it's like the markets, right? When we think about 2026, what's the story going to be? In my view, it's CapEx to cash, right? We need to see how AI is going to, all this spend is going to result in the operational effectiveness. And at DWS, we focus on AI. How can we actually improve our returns in our investment processes? How can we get the efficiencies to ensure that we keep the momentum that we showcase to the market in terms of our cost-income ratio? So I think AI is a very, very important segment for asset management as we go through this transformation. If you do not invest into AI, you will definitely not be amongst the winners.
All right, well, Hepsen, we really appreciate you coming in and joining us on Open Interest. Hepsen Uzcan there, the CEO of DWS Group Americas. Let's get a check on what's going on in markets right now. A little over an hour into the session, we're looking at accelerating losses as Nvidia continues to fall further, now down about 3%. So the S&P 500 is down more than 1/3 of 1%. The NASDAQ down about 0.8% of 1%. When we come back, speaking of AI, my friend Tim Draper has cloned himself digitally. We speak to the Draper Associates managing partner and founder next, or maybe we'll talk to his twin. We'll see. This is Bloomberg Open Interest. Bloomberg's Odd Lots podcast is celebrating its 10th anniversary this week with two big interviews set to roll out in the coming days. Joining us now are the two big co-hosts, Bloomberg Odd Lots anchors Joe Weisenthal and Tracy Alloway. And this is pretty cool to have watched this build. I mean, for you guys also, it's obviously amazing. You're featured in the New York Times, for example. But It's just gotten an incredible followership over 10 years. Who are the two big interviews that we're prepping for?
Oh, so we have two great ones coming up. We have Cliff Asness of AQR and Jeffrey Gundlach from DoubleLine. And they both have a lot to say about the markets right now.
So tell us about the growth of this. You started it 10 years ago.
Yeah, we started it 10 years ago. You know, I always joke, but it's not really a joke. When we started the podcast, Bloomberg didn't have a podcast team at the time, which was very nice because nobody was paying attention to the fact that no one listened to it for the first 4 or 5 years of the podcast. Had anyone been noticing, it wouldn't have lasted this long. Eventually, people started listening, and you know, it grew and it became our full-time jobs, more or less. But yeah, we had no idea that what it would become, that we would be spending so much time on it, that have all these listeners. It's been a real delight.
I mean, you do live recordings in front of the studio audience.
Yeah.
You're like the armchair expert here. So what do you think's driven the popularity, besides you guys, obviously?
I would say there's a real demand for nuanced and detailed discussion now, and I think sometimes the media has underestimated it or underestimated that demand. People think that, you know, readers and listeners and viewers, they want like the 5-minute bullet points on a subject, but what we've found through the podcast is as long as you make the conversations engaging and interesting, people actually really want to go in depth and in detail. And so what tends to happen on Odd Lots is we get into a particular topic. So semiconductors is a classic one that we started talking about in early 2020. And then from there, we just learn more and more about that particular thing. And then we do more episodes and everyone sort of comes along for the ride and we're all learning together. It's sort of an iterative process.
And you've developed, there's a community around it, right? Because I know some super fans who are on your Discord. I don't even know what that is, but what is it?
Yeah, we have this page, discord.gg/oddlots. Anyone can go check it out right now. And there are people in there 24/7 talking about everything. There's like an AI page and a China page and an automotive page and an economic data page. And at any given time, there are people talking about all of these topics and sharing links and sort of this sort of community of people who, as Tracy said, just sort of want to learn about things and really enjoy it. And I think, you know, the media is diverse. There's need and range for the quick bullet points or the short segments, et cetera. But there's also the opportunity out there for let's just talk about something for as long as we can, as long as it's interesting. And if the guest is deeply knowledgeable, if they have high technical knowledge, and they can enthusiastically explain something in clear English, you get a broad audience of both sort of professionals and the lay audience as well.
By the way, do you get a bigger audience for example, you did an episode on the chicken population of the U.S., right? And it wasn't like you had Druckenmiller on. It was somebody that we in this industry have never heard of, and yet it was, I guess, one of the most popular episodes.
So this is really important. The perfect guest to us is often someone who can go like very niche into their particular industry, but make you care about it as much as they do. Someone who's really enthusiastic and, to Joe's point, able to explain very clearly. So we have episodes, for instance, one that we recorded relatively recently was with Ryan Fox, who is a paper and packaging analyst here at Bloomberg Intelligence. He's really into cardboard boxes. And we recorded, you know, an hour-long episode with him all about cardboard boxes. And at the end of it, I feel as enthusiastic and interested in the box industry as he does.
We did an episode earlier this year with this guy, the Lentil King of Saskatchewan. And if you just think, okay, like a guy who grows lentils in Saskatchewan, but think about how many things that touches, right? It touches international trade. It touches the politics that every country around the world with having domestic agriculture, fertilizer costs, logistics, because why are they in Saskatchewan? And how do they get the lentils from Saskatchewan to Turkey, et cetera? So here you take something sort of narrow, lentil growing, but it turns out that anything can be a prism to everything if you sort of frame the conversation the right way. I think that's one of the things that we've discovered along the way.
Any favorites? Do you have any favorites?
Oh, yeah. It's hard to choose. It's like choosing your children. But I would say one that sticks out is the economic history of nails. Do you remember that one?
Yeah.
People still bring that one up quite a bit.
One.
And the interesting thing about nails is we don't really think about them as a technological advancement. But the shift from wooden nails to metal nails turned out to be a really big deal in terms of economic growth for the U.S. especially.
The episode where Sam Bankman-Fried described yield farming as like, oh, you put money in a box and then more money comes out of the box. You know, got to be one of the classics. There's so many of those. It's so unfair. We did an episode with, I was doing TV at the time, and we talked to this guy, Stinson Dean, who is a lumber trader. And then that was such an interesting TV conversation. I was like, I want to talk to him for like an hour. We talked to him for longer. Then we've had him on the podcast a couple of times since then. You just learned so much about market structure and how markets work by sort of defamiliarizing ourselves with all these things that we abstract away or take for granted in more liquid listed asset classes. Well, how do lumber futures work? How are they priced? What's the contract based on? So many things you can learn from that was a good conversation.
I mean, I have to say that it has changed the way I view things on so many different occasions, on huge issues. From
I love that.
Mom Dani, you had him on.
We had the mayor-elect on. Yeah.
To Millet, because you had the author of a book about Argentina on, which really made me think about it differently. Thank you so much for doing it.
Thank you for having us.
All of your listeners really appreciate it. Tracy Alloway and Joe Weisenthal celebrating the 10th anniversary of the Odd Lots podcast. Coming up, Tim Draper has cloned himself digitally, and we're going to speak either to his digital clone or to the man himself, the managing partner, founder of Draper Associates. This is Open Interest. Tim Draper, as always, doing the work, leaning into AI to create himself. Draper is launching Talk with Tim. It's a digital twin available 24/7, which looks, sounds, and thinks exactly like he does. Users can pitch the bot ideas, learn about venture capital, help to refine their business models with Tim, or his digital twin. The AI bot has been trained on thousands of hours of Draper's speeches, public appearances, and writings. And joining us now is, we think, the real Tim Draper, the founder and managing partner of Draper Associates. We'll never know. This is going to be a problem that we have in the future for sure. But Tim, this is fascinating. When I saw this pitch, I immediately said we have to do this because you and your family, of course, basically invented venture capital. You've done incredibly well in this space. And I've had numerous people with businesses ask me, hey, can you hook me up with Tim Draper? Can you hook me up with Jesse Draper to try and talk through my ideas? And of course, you don't have enough time in the day for all those people. But I guess now you can make a business out of it. Is that right?
Well, yeah, I've always been curious when I saw that movie Multiplicity. I thought, oh, this big opportunity. I really would like to have a lot of clones out there doing all these different things that I'm doing, because it is very time intensive what I do. We do a lot of things for building deal flow and all that kind of thing. In fact, we use AI for deal flow too. We have a data lake of 250,000 companies, and the AI spits out about 5 a week for me to evaluate. But there are 5 digital twins of me so far, and one is on Draper TV, and that's to do news shows on all of our press releases from all the companies that come in. We have thousands of companies that we've invested in, and this is an opportunity for them to get a news show about their press release. And then on Draper.vc, we have tips on how to better improve your business model or your business, and you can input as an entrepreneur, you can input your deck, and out comes advice and some criticisms and some suggestions for where to move this to make it more investable.
I mean, it's a fascinating.
And then once we funded a company, one more thing. Once we funded a company, we have a hotline, and that hotline is it's only voice, but people have talked to my voice hotline for like hours because it's smarter and better looking than I am. And that hotline is for the entrepreneurs to give them advice. And so, and also at Draper University, we have on a proto, there's this giant phone booth, and it looks like a phone booth, and my image is in there. My holographic image is in there. and you can people have talked to that for several hours, and that is a really good-looking and smarter version of me. And I think ultimately most of my work will be better done by my digital twins.
Tim, I wonder if you also have a business to build digital twins for others, because it's, the possibilities are endless. You can imagine a doctor who doesn't have enough time to see all the patients, or a lawyer who doesn't have enough time to deal with all the clients. So many people could use this in business and really make money with it. How do you see the future of digital twins?
I think they are fabulous. They're a great way for very, very busy people to parse out some of the work that they do that is repetitive or redundant, and I think that they also can tap into the LLM, which gives you, the exposure and the brain power of, 6 billion people. And I think that by experimenting with them early, I think we are going to have a great edge moving forward as investors, because I think they will be attractions for entrepreneurs, and I think investors will also see that we have a particular edge in the business.
Do you ever think about the problems? I mean, the fact that, one of my producers, Sarah Mazzulli, said, "I think this is the bot." So she doesn't believe you're the real Tim Draper. Will we have a watermark?
This bot?
Yeah. I mean, how do you deal with that kind of concern?
Well, so far my digital twin hasn't laughed. So I think that we've got it for a while. But I think that there are, and also my digital twin speaks perfectly, really doesn't make mistakes, doesn't say or ah or whatever.
Nice.
And I think that will be the discriminating factor for a while, but eventually all things can be improved in software. I think we've got, I think it's a major opportunity for people. I think AI in general, we use AI to evaluate entrepreneurs now too. With Otter, we have recorded all the conversations we had for about 9 years. And now Otter is sending us information like, oh, you met with this person before, he was pitching something else. Or you've met with this person. There, I don't think the digital twin would have coughed.
No, and maybe it will be easier to interrupt. Tim, unfortunately, we've got to draw this to a close because we're running up against the end of the program, but I really appreciate your time. Tim Draper there of Draper Associates on his digital twins. And also a shout out to Multiplicity with Michael Keaton, great movie. Tomorrow we have a great show coming up with Mira Pandit, among others, and Jason Chinnick of Ducati. Don't miss it.